Hello everybody, this is Professor Lambert on valuation of privately held companies, and this is the discussion of the levels of value chart. The levels of value chart has a nice graphical representation which I've produced on the screen here, and this is a way of thinking about the different valuation approaches that we use and where they put us on this levels of value chart. And that's what we're going to walk through right now. So first of all, a little explanation of the chart. Whenever we do a valuation, we want to make sure that we understand what we're actually valuing, the specific interest in the company. So if I was valuing a company for a matrimonial matter and the person owned 60% of the business, that's a controlling interest. If I was valuing a company for someone's estate and they own 10% of the business, that's clearly a minority interest. So we're always going to start with this idea of is it a minority interest that has or is it an interest that has control? Now, different valuation methods are going to be at different levels of value on this chart. So for instance, if we do a method that results in us having if we do a method that implicitly gives us a controlling interest result and we want to get to a non-controlling, non-marketable interest result, there are ways we can adjust this value to take us down to the levels that we need to get to. And we'll get into those a little bit more. That's through our lack of control discount and our lack of marketability discount, and we'll discuss those a little bit later. But just know that we can employ any valuation approach and still get to the proper value that we need to get to for our subject company valuation. So let me back up now and discuss these different methods and what value they give you. Okay, I'm going to start with the asset-based approaches. Remember, in the asset-based approaches, which was the adjusted book value or ABV approach, as well as the net asset value or NAV approach, we made an assumption that we could mark all the assets to their market values, subtract the liabilities, and the result would be the equity value of the company. Now, to realize the value of those assets, we would need to have control. So somebody can't liquidate any of those assets unless they have a controlling interest. So those two methods, the adjusted book value method and the NAV method, net asset value method, are going to give us a controlling interest valuation. If I owned control of a company, I could sell all the assets, I could liquidate everything, pay off all my liabilities, and then come up with the equity value. Now, just because we use those methods doesn't mean that that's what's going to happen to our company, but it helps us get to a value of control, assuming that the assets could be sold. And again, if we're valuing a non-controlling interest, there are ways we can adjust this controlling interest value to get to the proper level. Let's now think about the market-based methods. We had two market-based methods: comparable companies, which traded in the public stock markets, the NASDAQ and the New York Stock Exchange. And then we had the mergers and acquisition method, where one company acquired control of another. So let's start with that second method, the second approach, the M&A method. If one company acquired another company, where do you think that valuation would occur on this levels of value chart? Is that a is that a controlling interest valuation or a non-controlling interest? Pause the video for a moment and make your prediction. Okay, welcome back. So for those of you who predicted that the M&A method would give you a controlling interest valuation, congratulations. That's exactly correct. When one company acquires the controlling interest in another, that tells us what did they pay to get control. So that's a controlling interest valuation. Again, even if we're valuing an interest that is a non-controlling interest, we can still adjust this controlling interest value to get to our non-marketable, non-controlling number. Okay, let's talk about the other method in the market approach, and that would be the comparable company, looking at the value derived via a public company stock. And again, the way we would use this is if we were valuing a coffee company, let's say, we would go and look for coffee companies that trade in these public markets, look at some of their valuation multiples, and then apply those multiples to our company's accounting measures, its earning measures, and thereby come up with a value. So what kind of value would that give us? Well, because publicly traded companies are fully marketable, meaning that if I sold my interest in a publicly traded company, I would have my money in 2 to 3 days in my account. That means that interest would be fully marketable. If I only had, anytime anyone buys a publicly traded company, they're trading a minority interest stake unless it's a merger and acquisition. So when you see the stock market and the value of a company fluctuating on a day-to-day, moment-to-moment basis, all those transactions are small blocks of stock, 100 shares, 1,000 shares, maybe 10,000 shares. Those are all non-controlling or minority stock interests. If you start looking at publicly traded companies, you'll find that some of these companies have 200 million shares outstanding. So even somebody trading 2 million shares would only be trading 10%. So what you see trading in the public markets are minority interests. So if we were to use the comparable company method, that puts us here in the middle of the levels of value chart. As if freely traded on the public stock market. And again, the multiples we get from comparable company transactions are indeed freely tradable. They're quick to liquidity, and they're non-controlling interests. So before we go to the non-controlling, non-marketable, I just want to talk about how to get back and forth between these two companies, these two levels of value on the chart, the controlling interest and the marketable minority. If a company is trading in the public markets and then is taken over by another company, you often see a jump in the stock price of the company that's going to be taken over. And we're going to discuss this in class more. That jump in price is called a control premium. So I might have a company that's trading at around $100 a share, and then one company announces, hey, we're going to acquire that company, and the stock price often jumps up. Some say, I'm going to make up a number, it jumps up to $120 a share. Well, it was trading at 100, now it's trading at 120. That $20 increase in value is called a control premium. And we can also convert that to a percentage, saying the control premium was a 20% control premium. Likewise, if we started out with a value that was control and we want to convert that to a non-controlling interest, we can apply what's called a lack of control discount. And what this means is if you told me something would be worth $1 million if I had control of it, but you're only offering me a non-controlling interest, well, I'm not going to pay a pro rata $1 million value. I'm going to discount that interest for the lack of control that I would have. And we'll talk more about that in class, about how we get quantitatively to the lack of control discount. So just realize that the control premiums are often data that we have from observable market transactions where one company is acquiring another. That gives us the control premium. We can convert those control premiums into lack of control discounts to use to get from the controlling interest value level down to this marketable minority interest level. Let's talk, before we talk about the two income approaches, the DCF and the capitalization, let's just talk about what if a company has a transaction in its own stock. What if I'm valuing a private company and I find out that, hey, a year or two ago, we sold some of our own stock to another person, or we bought back some stock from another person. Well, if that interest that was purchased was less than a 50% interest, we'd have a non-marketable, non-controlling interest. Non-controlling because it was less than 50%, and non-marketable because if I have a transaction with a privately held company, buying a non-marketable share equity interest from somebody, that's also gives me a non-marketable number. So if I had a company that had transactions in their own stock, sorry about that, transactions in a private company's own stock, that would be a non-marketable, non-controlling interest as long as it was less than a 50% interest. Now, the other two methods, the DCF is generally deemed to be an enterprise level projection. So the DCF is generally deemed to be on control. In practice, I've seen this applied in different ways. Some people assume that the controlling interest, a DCF, is always a controlling interest. I've seen some people say that the DCF is just representative of the company's cash flows, whether that's minority or control. But for our purposes, a DCF is going to be on a controlling interest basis. So we would put it up here. Have to put it on this side. And then finally, the capitalization of cash flows is our final method. And this one has a bit of nuance to it. Now, there are times that you will make adjustments to the cash flow of a company. And some of those adjustments will be deemed controlling interest adjustments, meaning only a controlling shareholder could make such an adjustment. If you do that, then your capitalization method will be on a controlling interest basis and would have to be discounted for lack of control and lack of marketability to get to this non-marketable, non-controlling interest level. However, if you have a capitalization analysis where you do not make any changes to the cash flow and it's a bunch of minority shareholders, you will be at this marketable minority interest level. So that's one where there is some nuance and some decision-making process that are involved. We'll talk in class about what some of those factors are. What is a controlling interest adjustment? What is not? And we'll get to those. Finally, I want to discuss a little bit about this lack of marketability discount, because this is a huge discount in the difference in value between a publicly traded company and a privately held company. The lack of marketability discount represents the fact that the privately held company does not have the same liquidity that a publicly traded company has. Again, with a publicly traded company, I can sell my stock and within 2 to 3 days that cash will be in my account. For a privately held business, a non-marketable business, it could take me months or longer, years, to sell my business interest. I have to prepare the company, or prepare the buyer by providing them with my financial statements, which again are likely not audited. So the buyer is going to be skeptical, more skeptical than if those statements were audited, and will have to evaluate whether my numbers on my financial statements are trustworthy. The buyer will also want to investigate the company, my markets, my growth potential, any liabilities I may have. I could have a lawsuit against my company, and that's something that a buyer would want to know about before making a decision whether to buy into my company. So there's a lot more complexity when you are selling a privately held business, because there's not the quality of financial data you have with publicly traded companies. And there's also issues with the buyer having to do a due diligence and find out about my company. So we'll talk about some of the studies that are sources for what this discount is. This is a reduction in value that would occur for a privately held business, and we'll get into some more of those details in class. I hope you found this useful.